Most people notice interest rates only when a loan suddenly becomes expensive. A house payment jumps. A credit card balance grows faster than expected. A business delays hiring because borrowing costs too much. But an interest rate is not just a number printed by a bank. It is the price of using someone else's money, and that price quietly changes how people buy homes, start companies, save cash, and manage debt. At the simplest level, interest is payment for time and risk. If you borrow money today and repay it later, the lender gives up the ability to use that money during the waiting period. The lender also takes the risk that you may not repay. Interest compensates for both. For the borrower, interest is the cost of getting money now instead of waiting until they have saved enough. Imagine borrowing $10,000 for a car. The principal is the original amount borrowed. The interest is the extra amount charged for using that principal over time. If the loan has a 5% annual interest rate, that does not automatically tell you the exact monthly cost by itself. The final payment depends on the loan term, repayment schedule, fees, and whether interest is simple or compounded. This is why two people can borrow the same amount and pay very different totals. A 5-year loan usually has a lower monthly payment than a 3-year loan, but it may cost more in total interest because the debt stays alive longer. A borrower may feel relieved by the smaller monthly number while missing the bigger lifetime cost. Interest rewards speed of repayment and punishes long delays. For mortgages, the effect can be dramatic. A home price may stay exactly the same, but a higher interest rate can make the monthly payment feel like a different house. For example, on a large mortgage, a move from 4% to 7% can add hundreds of dollars a month, sometimes more depending on the loan size and term. The buyer did not choose a more expensive home. The money became more expensive. Banks do not set every rate from nowhere. Many rates are influenced by the central bank rate in that economy. When a central bank raises its policy rate, it usually becomes more expensive for commercial banks to access money. Those banks then pass higher costs to borrowers through mortgages, personal loans, business loans, and sometimes credit card rates. When central bank rates fall, borrowing can become cheaper, though not always immediately. Central banks often raise rates to slow inflation. If prices are rising too quickly, higher rates make borrowing less attractive and saving more attractive. People may buy fewer houses, finance fewer cars, or delay big purchases. Businesses may postpone expansion. Lower demand can cool price pressure. The trade-off is that higher rates can also slow growth and make debt harder to manage. Lower interest rates work in the opposite direction. Cheap borrowing can encourage households to spend and businesses to invest. A company may borrow to buy equipment. A family may take a mortgage because the monthly payment fits their budget. Investors may move money out of low-yield savings into riskier assets. Low rates can stimulate activity, but if pushed too far, they can also encourage excessive debt and inflated asset prices. Your personal interest rate also depends on your risk profile. A borrower with stable income, low existing debt, and a strong credit history usually looks safer to a lender. A borrower with missed payments or high debt may be charged more because the lender sees a higher chance of loss. This is called risk-based pricing. The same loan product can carry different rates for different people. This is especially visible with credit cards. Credit card rates are usually much higher than secured loan rates because the bank has no house or car to take back if the borrower does not pay. The loan is unsecured, flexible, and easy to reuse. That convenience raises risk for the lender and cost for the borrower. A small unpaid card balance can grow quickly if interest keeps being added. Interest can work for you too. When you deposit money in a savings account, fixed deposit, or bond, you may receive interest because someone else is effectively using your money. The same idea is reversed. You become the lender, but the rate you earn is usually lower than the rate borrowers pay, because banks keep a spread. That spread helps cover operating costs, risk, and profit. Nominal and real interest rates are important to understand. A nominal rate is the stated rate. A real rate adjusts for inflation. If you earn 4% interest but prices rise by 3%, your real gain is only about 1% before taxes or fees. If inflation is higher than your interest earnings, your money can grow in numbers while losing purchasing power. Businesses watch interest rates closely because borrowing is often tied to growth. A restaurant may want to open a second location. A manufacturer may need new machines. A startup may finance inventory. When rates are low, the expected profit from expansion may exceed the borrowing cost. When rates rise, the same project may no longer make sense. Interest rates can decide whether an idea stays on paper or becomes a real investment. Governments also feel interest rates through public debt. When a government borrows, it pays interest to bondholders. If rates rise, refinancing old debt or issuing new debt can become more expensive. That can affect budgets, taxes, public spending, and political choices. Interest is not only a household issue. It can shape national financial decisions. Investors use interest rates as a comparison tool. If safe savings or government bonds pay attractive interest, some investors may demand higher potential returns before buying risky assets. When safe returns are very low, people may be more willing to take risk in stocks, property, or startups. This is why rate changes can move asset prices even when the companies or properties themselves have not changed overnight. The biggest mistake borrowers make is focusing only on monthly payment. A lower monthly payment can hide a longer term, more total interest, or expensive fees. A better question is not only, €1 can I afford this month? €1 it is. €1 how much will this debt cost me from start to finish? €1 that question reveals the true price of borrowing. Another mistake is assuming rates affect all debts equally. A fixed rate mortgage may keep the same rate for years. A variable rate loan can change. A credit card rate can be high and punishing if balances revolve. A promotional 0% offer may end suddenly and become expensive. The type of rate matters as much as the size of the rate. A practical way to use interest rate knowledge is to rank your money decisions by cost. High interest debt usually deserves urgent attention. Low interest, fixed, manageable debt may be less dangerous. Savings should be judged against inflation, not just the printed rate. And any new loan should be tested under a higher rate scenario, especially if the rate can change. Interest rates are powerful because they turn time into money. Waiting to repay costs more. Saving earns more. Borrowing sooner can help you buy or build before you have all the cash, but it also creates an obligation that follows you into the future. A rate is not just a percentage. It is a contract between today a euro's choices and tomorrow a euro's income. So the simple definition is this: an interest rate is the price of money over time. For borrowers, it is a cost. For savers and lenders, it is a reward. For economies, it is a steering wheel. When you understand how rates connect loans, savings, inflation, risk, and monthly payments, financial decisions become clearer. You stop asking only whether money is available and start asking the better question: what will this money really cost?